Welcome back. Now, the South African Reserve Bank has cut rates. This after a pause in the cutting cycle earlier in March. The repo rate currently sits at 7.25%. And joining me now as we unpack the decision is Johann Els from Old Mutual and Annabel Bishop from Investec. Annabel, Johann, thanks so much for joining us again as we unpack this move. And I guess let's start with your reflections, Johann. Perhaps the MPC's tone and what you've made of it.
Just if we look at the vote split, where 5 members voted for the 25 basis point cut and 1 member even for a 50 basis point rate cut, that was quite a dovish outcome compared to what we perhaps thought. Also, when you look at the inflation forecasts, the detail thereof on a quarterly basis, quite a substantial cut in the inflation forecast this time around. So for another meeting, all of the meetings since July last year, the Reserve Bank have reduced their short-term inflation forecast. And this time around, even the 25 and 26 and 27 forecasts were cut quite substantially. So I think that was quite a dovish outcome. And to some extent, those reductions in the forecast, the assumptions they used for that, for instance, the oil price, they've reduced from around $75 per barrel for the Brent oil price to $70 per barrel. And it might actually come out lower than that. So there's still room for further easing of inflation forecasts from the Reserve Bank side. And I think this almost cements the next rate cut at the July meeting, which will likely then also be 25 basis points. But the fact that 1 member of the MPC voted for 50 suggests that the impact on interest rates from the substantial lowering of inflation pressures and the Reserve Bank's inflation forecast is being seen in terms of policy making.
And Annabel, your thoughts, Johann there touched on how the decision wasn't unanimous, with 1 member voting for an aggressive 50 basis point cut.
Yes, look, I think, overall the outcome was as expected. It's very positive for the economy and for consumers. We obviously are in a weak economic growth environment. Expectations that economic growth would be around 1.7, 1.8% this year have been revised down towards 1.2, 1.3%. And of course, we continue to see poor economic data coming out from the first quarter overall. It's actually a risk that we could see a contraction in the first quarter. I think that probably drove some of the dovishness of the central bank outcome today. The 50 basis point cut, the 25 basis point cuts, suggestions are all reflective of that. And of course, we do find ourselves now going into the second half of the year from the July meeting, and that really has, I think, shown the global environment has seen a bit of a downtick in concerns or worries. Perhaps I'm reading that maybe the worst has been done by the Trump administration. That's not necessarily going to be the case, but I think by and large it might well be. And this also might add to some confidence for the Reserve Bank to be quite dovish, evidenced again by that 50 basis point cut suggestion that you mentioned. So, if you have a 25 basis point cut now, I think this does leave the door open for another 25 basis point cut this year. We continue to expect the 2 cuts. And if it doesn't come in July, then it certainly might come later in the year. We've got a couple more meetings after that. Overall, though, it's a very positive outcome, very cheering, the right decision to have made. It's always difficult to second guess the Reserve Bank because, what you think they should do, as Johann said, is not necessarily always what they do, actually do. But given that the FRA curve was really factoring in a rate cut the closer we got to the meeting, it became apparent that that's probably what would happen. So a really positive outcome.
And let's talk about growth for a bit, Johann. Annabel touched on how the Reserve Bank has lowered its forecast for GDP for this year to 1.2%. We also saw the same thing play out at the budget last week, with Treasury also lowering its forecast. I'm sure this was, expected, considering the macroeconomic conditions and how that has changed from the beginning of the year to around the end of the first quarter.
Absolutely. As Annabel said earlier, the first quarter is going to be pretty weak, slightly negative even. So that sets a very low starting point for the year. And then, of course, the global risks that has impacted in terms of forecast revisions that we've seen. I do think there's some upside risk to those forecasts because very low inflation, lower interest rates, that's all very supportive of consumer spending. So we're certainly not going to see a consumer spending boom anywhere near what we saw in the early 2000s, but certainly somewhat better trend in consumer spending growth as a result of continued very low inflation. Virtually everybody in this country who's got a formal employment got a bigger than inflation salary or wage increase this year. So that certainly supports positive real growth in incomes in line with lower interest rates. That's certainly supportive of better consumer spending. That on its own will support economic growth. So I think there's some upside risk to the 1.2% growth forecast. Nevertheless, that's still weak, but it's certainly double what we had last year. So there's an improving growth environment off the back of structural constraints being gradually eased. And of course, the cyclical side of the economy seems to be a bit stronger in terms of lower than expected inflation and the continued rate cuts.
And sticking with that conversation around growth, Annabel, it does seem like the Reserve Bank is positive, or it was more positive than expected on, just structural reforms. They have mentioned that there are headwinds. What's your just your take around the trajectory when it comes to structural reforms? We had the budget last week, and we are still stuck with lower revenues, even as the Treasury has scrapped the VAT. We are seeing that a few levy that could possibly, fill that hole, but it's not enough. So do you think we have, enough funds to get the reforms going?
Yeah, so we recently saw the launch of Operation Vuvundlela's second phase, which obviously has provided a bit of positive optimism, I think, being reflected today, as you mentioned. Also, of course, as well in the budget, a strong focus coming through in the narrative. The words growth and infrastructure came through many times. So again, also, highlighting the issue. Your question about funds and do we have what it takes, I think there's quite a few things we can talk about there.
Okay.
One of which, however, is the concern that Transnet still has a lot of debt. It finds it can't borrow more affordably to actually allow it to improve the infrastructure, the repair, the maintenance, the really change that needs to take place in terms of funding its increase in capacity to provide freight services around the country. So that's still a big worry. We didn't see that really coming through clearly in the budget. The other cause for concern, obviously, is that government itself, as we all know, doesn't have the money for a large infrastructure build and drive, and is looking to work with the private sector, but also for private sector funding. Now, I suppose that's where we do have a concern that it continues to lag. Very much we're in the planning stages. We actually aren't seeing public-private partnerships deliver. We're seeing a lot of planning, a lot of regulatory work, all of which is important, but it's dragging. It's taking a lot of time. So, of course, that is a worry for economic growth. One of the reasons why there have been downward revisions for GDP growth this year. Not all about the global environment.
Yeah.
A lot of it's to do with the domestic environment and the fact that, we're seeing government drag its feet in terms of what's needed to resolve the domestic freight crisis in South Africa. So unfortunately, there is a cash crunch. There is money that needs to be spent, and the quicker government manages to resolve all its rules and regulations and actually start to affect public-private partnerships to come into being and to start really delivering is imperative for us to see quicker and faster economic growth. Unfortunately, that held us back last year, and it looks like it's going to hold us back this year as well.
And sticking with, conversations around SOEs and the turnaround plans that have been playing out there, we have seen some progress when it comes to Eskom. But of course, as Annabel mentioned, troubles still lingering at Transnet. We even had Moody's recently, issue out a dire cash warning of what's happening there at Transnet. What have you made of the turnaround process taking there? It does seem like it's really slow, Johann.
Absolutely. These things are always far, far, far slower than what we need and far slower than what we want. Fortunately, it's moving in the right direction, even though that's slow. The right direction is important, but of course, it takes so much longer to get to the better growth path that we absolutely need. But at least what it seems is that Transnet's volumes on its system has slowly picked up from 2023 into the first half of last year, into the second half of last year, and apparently still slowly improving. A better, stronger private sector involvement in that will also help, but of course, that is slow as well. It takes some time to get private sector operators to accept the tariffs that Transnet wants to charge, etc. So there's a strong process happening, but it takes some time to get to that. Electricity has been our best example where the private sector involvement there significantly eased the constraints there. There are still constraints. Some improvement in Eskom itself, but it's the private sector role that is helping. Now we need the private sector in terms of electricity grid as well, water supply. So it's a process. Unfortunately, it's a very slow process, but I think we're starting to see some of the benefits of that.
All right, let's move over to the inflation target yet again. It does seem like the SOB is very adamant about that and just lowering the inflation target. Annabel, where do you see this target perhaps falling? Do you expect us to maybe get another range, or will we get like a target like the US and the UK where they just have that target of 2%? Or do you think we'll still get another range?
I think we'll still get another range, and the governor talked a lot about the 3 to 5% band, how we wavered from it, we should have not, and obviously that could well be the starting point, how we should have gone back to that, probably how we should be at it, I think he inferred. So really that, of course, is most likely where we'll land up. They talked about a narrowing of the band as well, and that gives us a narrower band, so not a point, but also the situation that we find in South Africa, the lower inflation, it does give us course to really drop the inflation target range now, narrow it, as the Reserve Bank governor said, is most likely. And then, of course, that would mean that our midpoint is 4% instead of 4.5. Now, if you look at the forecast that came out, they dropped the one for next year, their key targeting period, really to 4.2% from 4.5%. We think there's scope or further downside to this. It might come out at 4% at the next MPC meeting in July. Johann also mentioned this as well. There are many downward pressures on inflation, or moderating pressures, if you will. So we think overall that we probably are going to see a cautious approach, a moderate change, 3 to 5%, although, of course, the governor talked about preferring to go to 3% as a point.
Now, with inflation risks to the downside, Johann, what, or rather, how many more cuts do you expect this year? I know Annabel mentioned 2 25 basis point cuts. What are your expectations?
Even before this meeting, I said we should be expecting another 75 basis points of rate cuts, so 3 times 25. So we've had one now. I think the extent of the cuts in the Reserve Bank's own forecast suggests to me that, yes, there's room for another 2 25 basis point rate cuts. That would certainly be helpful for consumers as well. And I think that would be appropriate. Another 2, so another 50 basis point in rate cuts, but then I think the Reserve Bank will hold off and keep on, as they say, watch the data, see how the situation unfolds, and of course then we look forward to if and when the lower inflation target gets announced, which I still think will be later this year, and I think the Reserve Bank would then be holding off on further rate cuts to see how this unfolds, because to cut too dramatically or too drastically, if you don't know what the inflation target will be, would be inappropriate in my opinion.
All right, let's leave it there. Thanks so much for your time and sharing your insights. That was Johann Els from Old Mutual, as well as Annabel Bishop from Investec. I'll be bringing you the close this evening at 5:30 p.m. Until then, stay tuned for lots more coming up right here on Business Day TV.